we're going to go through the fourth quarter railway companies in the US because to me, this is one of the most important industry groups that no one looks at. And yet, in so many ways, it's one of the absolute pulses of what you're going to get as far as information goes on the macro level. And it's kind of amazing that no one looks at it, given how much data they throw off. So I'm going to share my screen right now and just get straight into it. Past performance is not indicative of future returns. I currently have no positions on the rails, but given the data they throw off, I have tons of positions that are associated with the things that I'll be talking about today. Now, the key book that is really going to tell you why the rails are so important and used to be a true seminal piece of anyone working in financial services. This was somewhat required reading. It's a very long book. So sometimes people would get to this much later in their career. They would get to it much later in their career, and this would be Ayn Rand's Atlas Shrugged. And if you read Atlas Shrugged, it'll explain to you very clearly why the rails are so incredibly important. This is what the rails look like for the United States. Almost these three public companies plus BNSF transport most of the stuff throughout the nation. And then Kansas City Southern Railway was acquired by Canadian National Railway. And so really, you're left with three railroads that are public that will give you quarterly details on what was shipped throughout the United States. And then Berkshire is Berkshire, so we don't get that information, even though it's quite beautiful if you are able to incorporate Berkshire. But what they have to say has implications for nearly every single industry and company. I'm probably going to hit hardest on coal and the general merchandise companies, but I'll show you all of the data so you can figure it out for yourself as well and decide how it affects your investments. Okay, next slide. I just want to show you, because it's only these three that are public, it's very important that you get a sense for what the map looks like. Union Pacific is absolutely the West Coast. And what you want to remember is that historically, these rails were built to ship stuff out west. So almost all of them go to Michigan. All of them go down to the waterways, down the Mississippi, et cetera, through the waterways so that you can ship over through to the East Coast and across the Atlantic. And then obviously on the West Coast. And these shipping lines absolutely are a core port of infrastructure that then tell you what made it off the ports of LA, in other words, coming into the United States from Asia, and whether or not different things made it from the East Coast over that we produce. Things like all the industrial stuff that comes out of Michigan, et cetera. Okay. So that's Union Pacific. Norfolk Southern has this railway line. They do not go out west. They are primarily an East Coast line, but they are a little bit longer haul and a little bit slightly different in use case to CSX, which is absolutely that shipping along the Atlantic and Eastern Seaboard. Okay. Now, I really, just so you can get a sense for the miles of track, that's why you can't just go by Union Pacific as the biggest rail line, because the amount of geography they're trying to cover and what it implies is actually happening is very different from Norfolk Southern. It's very different from CSX and so on and so forth. If we had the information from BNSF, we'd have a better picture, because BNSF actually goes all the way across. It's kind of this beautiful thing once you realize how this world is set up. Very well described in Ayn Rand's book, Atlas Shrugged. Okay. Let's talk about one of the major things that always let's go through the earnings very briefly. Here is what ended up happening on the quarter. Union Pacific was not able to, you've got strikes, you've got fuel costs that have doubled for the rails, and yet still it is the case that shipping by rail is significantly cheaper than anything else. And it is still the case that if that physical good is not technology, it actually has mass, okay, then it's going to be shipped via rails, because that is always going to be the best way to get it from point A to point B in a landmass that is the size of the United States of America. So Union Pacific had the weakest quarter. Interesting, given that that's not necessarily what you expect, but some of that had to do with the strikes. Norfolk Southern had the strongest. That has very specific geography, particularly given what the mix of what they did was. And CSX had a solid quarter. In fairness, CSX to me is the best run of these rails. Whenever you then hear some of the companies talk about which railway is actually messing up versus which are doing great, it becomes very clear that CSX has the best reputation in the rail space. And even if you listen to the call, you hear a very different call from CSX versus the other two railways, which seem more on their back feet trying to fix things. Okay, the number one intelligence thing that you can get off the rails has to do with coal. Every day of the week, it has to do with coal. And somebody asked the other day about what I was seeing in coal. How do I feel about Peabody versus Consol versus Arch? And the fact is, the coal companies have gotten clobbered because everybody believes because of the oil price, lottie, and then because China's opening up, China's a huge producer of coal. And so that's the end of the coal run up. And that's just nonsense. I don't know another way to say it. If you look very carefully at here, you'll see that coal, the Union Pacific didn't do as much coal in theory, but that's only because they mixed their coal number with renewables. As you can see, they made it very clear that the increase in coal demand was strong, even off the West Coast, which, by the way, the West Coast is not the biggest user of coal by any means. If they literally have any other option, they'll do it. But nonetheless, they bought coal. And the reason that the U.S. continues to buy coal is because of what's going on in nat gas and the fact that the utility companies are always afraid of what's going to happen to the grid. So there's no slowdown in coal, guys, as far as that goes, at least as far as the rails are telling us. Now, you can see that the volumes off of Norfolk Southern are pretty good as well in coal, up 28%, but even your volumes up 8%. And then CSX, you'll see the volumes are up 9%. Okay, here's the deal. On the East Coast, you got two types of coal. Let me show you the map again because you're going to need to see this on the map. And this is what I always say. Peabody's coal is located here in the Wilmette area, Cheyenne, Denver area. You see where those lines are? That's what delivers the coal for the western half of the United States. Arch, now, it is the case that both Consol and Arch also are in this area digging up coal. But Consol is really over here in the Appalachians, and then the southern Appalachians is really Arch coal. So both, and so you can really kind of get a sense for Peabody versus Consol versus Arch on who actually delivered the coal. Those are really your three major coal producers in the United States, and among them, the numbers that you're looking at. Some of it has mixed up stuff in it, as it does with Union Pacific. But then with Norfolk and CSX, you're still seeing very strong volumes and very strong revenue, which means it did cost more to move the coal, but people were willing to pay it. And also, when they talked about coal, the reason the volumes were as low as they were, even though they were up 8% year over year, was because they didn't take as much coal out of the ground as you would have anticipated. The other thing, too, is the mix of coal has transformed, whereas thermal coal has been strong for the entirety of the last 3 quarters, given what we've been seeing in oil, nat gas, et cetera. Thermal coal has started to pick up as well. Metallurgical coal has started to pick up as well. And what I wanted to mention there is that you get 2 kinds of coal. Met coal is used for the making of steel, and then thermal coal is used for heating things. So the utilities companies are interested in thermal coal. Overseas countries that may not have enough nat gas and the such are interested in thermal coal. They're also interested in metallurgical coal. And between the two, Consol doesn't nearly have as much met coal as it does thermal coal. So that's how that lays out. But you can see very clearly that this weakness in coal may be a little bit not the right call, so to speak. But nonetheless, that's how it's trading right now. Yes. The railway strike will not affect coal prices except to bring them up. Okay, because here's the thing, the rail strike, probably Union Pacific out of all of them is going to be the most affected. CSX, largely speaking, has more or less managed that a little bit better than the others, which is why Consol, which is much more attached to CSX, is why I tend to play CSX. I just don't know how to feel about Arch Coal, which is more in the southern states, Arkansas, Alabama, that kind of area, the southern Appalachians. And then Union Pacific is going to be by far the most affected, given how far they got to move that coal. Okay, let's move on to the next. Great question, Israel. Thank you for coming and supporting as per usual. Really, really appreciate you on that. Okay, intermodal is your next thing. What is intermodal? Intermodal is the merchandise that goes into the back part of a truck, and then they stick it on a semi and do the last mile stuff. And we already knew intermodal was weak because J.B. Hunt came out with some very, very specific commentary about how even though they have probably re-upped their fleet, in other words, the trucks are newer and they've got more of them and they finally solved some of the labor situation. The fact is there's not as much intermodal moving. And we're seeing that even though this was up 2% for Union Pacific. For Union Pacific, this is off of not volume, but revenue. For Norfolk Southern down the middle, we can see that's down 4% on volume, even though they're getting pricing on through. And then again, for CSX, flat on intermodal, revenue up. That's not great. That is not great for Walmart. That is not great for Costco, and that is not great for pretty much anyone, Amazon, etc. Okay, so this, even though it's always the case that these companies can pull it out via pricing, via anything, by all this stuff. All of these guys reported that imports were slower and that inventories were really high. And they were not feeling great that I was going to improve gigantically in the second quarter or for guidance. So this was not an area where they were looking for growth. Okay, for the next year. Okay, now those are the two major things that are split out very clearly. From there, each one of these guys gives you a lot of granular detail on what was shipped. Excuse me. And so I'll go through each one by one because it's not as easy to compare and contrast after those two big items that really are kind of the mainstay, easy to compare across these companies. For Union Pacific, I want you to notice this autos number. This was actually pretty good. And then chemicals, very weak. And we saw that in Dow's earnings report, very weak. Metals actually improving, forest products down, energy and specialized. This is like the other stuff, not coal, is doing okay, not great, because most of this is pricing coming through. Grain didn't ship. This is not because there's not a demand for grain. This is because there wasn't enough grain to ship relative to the harvest from last year, okay? Fertilizer down a lot. Now, as much as I love Mosaic, unfortunately, across these three companies, it's very clear that not as much potash was shipped. Specifically in fertilizer, it's going to be potash that is the issue, and that is a very specific type of fertilizer. So that will 100% affect Mosaic, which is the largest producer of potash. Hurts my soul that that's the case because Mosaic is a Florida company and I'm from exactly right on top of where Mosaic is, but it is what it is. So I am out of Mosaic at this point. I will be clear on that. And then food and refrigerated was down 8%. This again is not because of lack of demand. This is because of lack of supply. And then that's Union Pacific. And you can see some of this is echoed in Norfolk Southern down the middle. Now, motor vehicles comes in flat, but they were clear on the call that that was coming from equipment and potentially industrial and not autos necessarily. But in fairness, this number was really strong last quarter and it is up against an easy comp. So I'm not thrilled that this number is so weak. Now, this number is going to be far more impacted by Ford and GM. So if you're long Ford and GM off of Tesla, you may want to just take a half a beat because this isn't very wonderful. CSX numbers are a little better in automotive. But then you can see what's going on in grain here. Similar story. Chemicals, very weak. And so on and so forth. Lumber weak, metals doing better, and so on and so forth. The one area that is a little bit funky, and I can't figure out why it is, are the aggregates, the cement aggregates. And we just had United Rentals report today. The construction was doing just fine as relates to industrial and other stuff. So it may be that even though housing has absolutely fallen out of bed, clear as day from a DR Horton and others that have reported that construction for home residential is down, it may be the case that you're getting enough cement demand off of industrial that it would be foolhardy to be too aggressive against this economy. So we are seeing aggregates up from Norfolk Southern. We're also seeing aggregates up at CSX, which is really surprising, the strength of that, given that it never really slowed down. Lumber's down, autos up, metals up, and fertilizer down. Now, the last little things that I'm going to mention is that this trucking supply situation. So trucking was very interesting because for a long time, especially during the COVID period, one of the great weaknesses was lack of drivers for the trucks, as well as just flat out lack of trucks, strangely enough. And in particular, lack of a particular type of truck that would lower the cost of fuel. Now, JB Hunt came out and told you this quarter that they were finally starting to see weakness after some crazy quarters that would make you feel like it wasn't even a trucking company. PACCAR, which makes Peterbilt and a bunch of the other big rigs out of Wisconsin, they had a great quarter. So people absolutely bought it, and they're still seeing strong demand, not just in the US, but overseas as people try to swap out old trucks for new trucks. So oddly enough, that is the dynamic that I'm seeing there for clarification. The other thing is that the fuel cost is still really high. Despite this oil price dramatically coming down, the fuel cost is high, and this has to do with diesel versus regular gas. And this has come up from time to time, but it's not fully appreciated. It shows in the rails for sure. So with that, that's actually all I have prepared. Let's see. I've got a couple of questions that I can see here from what I hear around the world. Some really good. I'm about to invest in chickens and sell eggs. Seems like a huge markup. Okay, here's the deal. You have aviary flu. So basically you have chicken flu. And so you do have actually less chickens. So I wouldn't necessarily, the egg price is really reflecting the fact that you had sick chickens. And so I don't know how to think about it either, but that is a real thing. So both the price of eggs and chicken is probably approximately correct. And that kind of just is what it is right now. Let's see. Another quick question. I don't get why people invest in anything over $1. Oh, sorry. You know what? I don't know much about Mullen, so I can't really speak to that. Buy Tesla for 140 and hope it gets to 280. Okay, don't know what to say to that, Israel, but you know I'm a fan of Tesla right here. I just had a video out on it last night. That was an unbelievable quarter. It now trades well below its growth rate. Most people think that that growth rate is overstated and try to make some silly argument about how like a 20 how like there's a long-term normalized growth rate similar to the regular autos. That fundamentally demonstrates you never bothered to read the 10K of the other auto companies relative to Tesla to understand what the difference is between them. And it is what it is. So I'm still a fan of Tesla. I think you are too, Israel, but I'm not for sure from your post. But I'll always be a Tesla bull at these levels, given how it traded and given how it continues to report. David, how are you? I'm going to bring David up. He helps me sometimes read the feeds that aren't coming through on my software. Hey, David, how are you doing?
I'm doing well. How are you doing?
Good.
The rails coming out of Michigan, you said cars were flat.
Yeah, the numbers. So the thing is, most of that auto number, because of where Tesla's located, really you're not going to, and especially because the volumes are, as a percentage of the United States auto volume, Tesla's still pretty small. Most of the auto number really is impacted by Michigan, so it's going to be Ford and GM, and those numbers are not bad. They're not super strong, but they're not. They're kind of in the middle. So up 9%. Yeah. Yeah, like we'll see. Because the thing is that you still have an increase in cost, and then you've got the financing piece. I don't have like you couldn't from this rail call make a strong call on what's going to happen in the auto sector.
Good. Okay. So if we're tracking Tesla, I mean, they're going to be shipped into LA, right? Or coming out of Austin.
They're going to come out of Austin. California's got its own deal, but there
Right.
is shipment on rails in California. Some of that is also going to be is going to just go straight out with trucks and stuff like that. So it is, Tesla's hard to tell off the rails, to be fair.
Okay. And, based on your call last night on Tesla, what do you have a price estimate based on how they're growing?
I think it should. I mean, to me, I don't think it should have traded under 200.
Okay.
Because at 200, it's still trading below its growth rate. I don't believe that the 30, so before it was like a 35% earnings growth, like if you did a growth rate. So it trades at about right now 20 times enterprise value to EBITDA. I don't care what anybody else says. I believe that is the right metric. And the reason I believe that's the right metric is there's no other metric that you could use to compare it to the other busted up old companies. And quite frankly, if you use any other metric and try to then compare it to tech, you're going to end up in an odd spot. So given that this company has $22 billion in cash and $5 billion worth of debt, meaning you got a net cash position, it would be foolish to use any other metric if you're trying to talk about what is the earnings power of this company. It trades at about 25 times as of last night. Last night alone, it grew its earnings at 50%. Even if you were to pretend to normalize that down, which I don't think you should, because everybody keeps pretending like this is a autos only company, then you like, what are you going to normalize it down to exactly? It still is only about 2 million cars a year. Just have a look at what the other auto manufacturers do. So it's, I think there's an absolute silliness whenever I talk to others about Tesla. I feel very passionately about this stuff. Like,
Yeah, and I just want to say 22 was a very challenging year, like,
it was.
right. And
It's a better operated company.
he did well, better than expected in 2022. He's
Yeah.
also, it's not, a lot of people want to say it's a car company, but I mean, it's AI. They've got that FSD that going on. Mega packs are big, and he brought up that he thinks that AI is very important.
Yeah, it is.
Car.
It
Right.
is. And here's the thing, AI probably is a few years out, but the net effect of training data for autonomous vehicles is to actually have a better mousetrap for AI, because there aren't that many companies that get real live data that they can test and train with. So 100%, the thought process that he's got, if you think it's just AI on cars, you've missed the point. Still, that portion, if you think about what Tesla actually is, let's ignore the fact that just from an auto's perspective, it is a significantly, not kind of, significantly better run auto manufacturer, if for no other reason than it's not an auto manufacturer with a crappy bank attached to it, which is what every other car company is. Let's just ignore that that is true. Okay. Then you've got basically the excess capital being thrown off to fund R&D across all the technology. The first piece that's very easy to see is the energy business. That thing is now year over year doubling revenues, more or less. And then you've got operating margins that are in fact coming down the line. The battery itself has value outside of automobiles by a lot, not by a little. Utilities companies are already interested in it because they're going to have to figure out how to fix this grid. And if you're confused that battery storage isn't part of the piece of that, let me just tell you now, it is in fact part of the piece of that, right? If you want those data centers to have off the grid power in case of a power shortage, and you believe that Internet of Things is a real thing that's happening, I don't know how it happens without battery storage. Okay. One. But two is exactly what you're saying. All the other stuff that he's talking about as relates to AI, the insurance business, which quite frankly is much smarter. I mean, having an auto insurance business attached to your business versus having a bank attached to your business that has to write the worst kinds of loans in the worst kinds of volatility marketplace, one is significantly smarter than the other. And so, I just feel like whoever, I get really frustrated when people come back to me with this whole, like, its market cap is bigger than all the auto manufacturers in the US. I'm just like, friend, I can't even talk to you. That is not what this company is.
Right. I mean, you brought up insurance. That's a huge revenue generator.
Yeah, because you got to think right now, if you're an auto company, you're probably mixing in a whole, like the way that you would do that math is you would bundle up a bunch of different automobiles so that you could have diversified risk across a bunch of cars, right? And then you would do it across a bunch of geographies. And of
Right.
course, it's going to be Tesla that is basically showing lower loss rates than every other car. Well,
Right.
if that's the case, Tesla can just go ahead and offer insurance, because if it's really Tesla that's bringing down the loss rates, why not just bring down the loss rate? I mean, write you a better premium. You know what I'm saying? Totally
Right.
makes sense to me.
Okay. So
Yeah.
price cuts will gain market share, obviously.
Yeah. And I mean, he was very clear, and we've talked about this. Albemarle, from time to time I get very bullish on, but my goodness, that thing is volatile. But the constraint on auto manufacturing right now is lithium. Talked about this. We don't make enough of it in the United States. They make some in Canada. Actually, I don't know if they make it in Canada because it freezes. I don't know if they can get it to it, but they make some. They make a ton in Latin America, and then China makes way more than any of us. And that is what it is. Albemarle is the only US pure play on lithium. There are a few smaller companies that exist, but they don't actually have their lithium manufacturing up and running yet. It's very cute because they'll say it sometimes like they do, but they do not. So, yeah, that's the
Israel says, Tesla holds no patents, according to Elon Musk. Seems easy to copy.
I'm not sure that that's the case. Let me review my notes from the 10K. I actually do think they have a few patents, especially on some of the newer stuff.
Right.
And yeah, that's true. And DJ, that's correct. DJ Trill. Oh, that's DJ Trill. Hey, Trill, what's up? So yeah, it is.
Look what
It
DJ
is. Yeah, this is true. The insurance business is going to be a cash cow. That's true.
Right.
What else we have here? I think you're in love with Tesla, May. I'm not in love with Tesla. Israel, look, I'm not in love with Tesla, but I can't handle when people talk as if they actually have bothered to look at an industry and they have not. So most of the arguments for against Tesla demonstrate that that person has not read one lick of any of the of either they have not read Tesla's releases and studied that business model, or they are in denial of what the legacy auto companies actually do as their business. It's only that drives me crazy, and it's the fact that they get so much airtime that makes me a little bit insane. Fair and square, that EBITDA number that he created is a real EBITDA. There's no trickery in it. There's no extra stuff going on in the numbers that he produces. And even if he was not an automobile company, hard pressed to create that much EBITDA in such a short period of time from zero. That's why I'm passionate about Tesla, is because I've never seen a company with so much misinformation by so many, in theory, relevant experts. It's just silly. Anything else?
No, it looks like Trill says hi. Hey, Trill.
Joe, what's up? I do want to just mention that the market is still crazy. Like, it's hard for me to be wildly bullish right this minute. Yeah, his only comparison out of China. That's true, Trill. The market right now is so insane because even though I'm very bullish on Tesla, I still have to kind of marry that with the idea that this market is incredibly weak. There were very few companies thus far that have reported truly positive earnings. Most have just reported, trickling revenues and then an ability to manage operating margins. But the ones that have actually puked out the quarter are pretty significant. By the end of the week, I will have listened to 100 of the 400 companies in the S&P, or 500 companies in the S&P 500. Sorry about that. And I'll have an update on how, like, generally things lay out. And if there's no other questions, that's all for now. See you guys next time. Good luck in these markets.